years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, in tonight's video, we're going to talk about a couple things. I named this video, Is Trump Panicking? And I think he is, but we're going to cover the dollar. We're going to look at the interest rates and much more. So let's get into tonight's video. Okay, welcome everyone. Got a lot to talk about tonight. As I suspected, we had a pretty ugly day on Monday. It kept getting uglier. We traded through the STX levels on the main indices and things got a little bit out of hand. So the rift between Trump and Powell keeps going on. In fact, I almost think that I mentioned that Trump is panicking. I think that is the case. I think there's a lot of things starting to break. And one of my biggest fears, and I've talked about this on the channel a number of times, is that between Doge, they've created an element of lack of confidence in the government. They didn't have a backup plan. I think things were kind of willy-nilly. And this was my fear. We're starting to see some things really crumble. Gold is just screaming higher. The dollar starting to plummet. We're looking at maybe a tariff strategy going wrong, maybe really wrong. Could get kind of scary if things don't stabilize a little bit. See if, so we'll also go back and talk about the treasuries, and maybe I'll even get into the yield curve tonight. So we may not do a traditional live stream that I do every night. We may get off the path a little bit today. There's some things I want to get through and try to unpack for you folks. It's interesting because Trump is screaming that Powell better lower rates right now or the economy is going to collapse. And I think they have disrupted things enough that this may be the case. I know a lot of folks seem to think I think that everything that Donald Trump does is perfect and good and right. I don't agree with quite a few things. And the one tactic that it's sort of like they just kind of walked into office and just started slashing and burning, and it seemed all fun until it wasn't fun anymore. And I think I've been talking about for days now, maybe for the last couple of weeks, that there's going to be some serious challenges coming out of this. And I'm seeing things starting to break down from the indices standpoint. I'll go through, I did something that, the reason why I was a few minutes late getting started, I was trying to get some things organized. And I ran a monthly data sheet. I ran the AI on the data sheet on the monthly stats, and I used the SPX because I need that data to get enough to calculate all the indicators and all that. So we'll go through that when we get to the S&P section. So I'm going to try to unpack a bunch of these thoughts that I just put out and take a look at them. Now, I think what we're seeing is market sentiment is continuing to deteriorate, and the things that I'm talking about is what everybody is thinking. Are the tariffs really going to crash things? And of course, it's all about Donald Trump and all that stuff. But okay, he might be the engineer of this, but now we have to deal with it. I don't. I've seen a lot of things in the last 45 years in being around the markets. And, somebody was talking, I think it was a comment on the YouTube channel, something about, did the Reagan administration say that they got played by the Fed and all that? No, I mean, when I first started in markets, interest rates, matter of fact, the scenario that got me to the markets, I was in a real estate business. And I went to Chicago to go trade on the floor because the real estate business was done in 1979 when I was starting. interest rates were on their way to 25%, and nobody was doing any business. So at the time when the Reagan administration came in, Volcker had been put on by Jimmy Carter, and it was stagflation and monster things going on in the banking system then. And a lot of things that we have seen happen in the last several years is what they were talking about 40 years ago happening, and they never happened. So you have to know that the financial media is probably the best at promoting stuff that doesn't happen. I always say, if you want to know what's not going to happen, go to Zero Hedge and read all the stories. None of that stuff happens. Okay, so that's a good one. It's sort of like Zero Hedge and Drudge Report, right? Anything that's on there never happens. But when we come back down to earth and we look at what's going on here, we can see some things technically breaking down. And I did reveal the book that I'm writing right now. There's a section on reverse fundamentals, which is where you take your technical and quant and you try to equate it to things that happen in fundamentals. And I have a bunch of questions and strategies that I use to put that together. So we'll talk a little bit about how to unpack some of that. But this is potentially getting to the point where we're right at that edge, right? You're right on the cliff. Last night I showed you the chart of the S&P, and I kind of drew in a scenario where we had another big leg down, maybe two, going into year end. I think this is a monster correction is coming right now. There's some elements out there that I put out in the Substack last night that you might want to look at. There is an area for congestion or consolidation at this point, but I think it's a hesitation before the next leg down. And I would say this, we'll go back to the Trump scenarios. I don't think that Powell will lower rates at all. In fact, he's out of a job in a year. Next May, I believe his tenure will be up. And, he doesn't like Trump. Trump doesn't like him, even though Trump put him in the office, right? Somebody was calling me out on my political bias on talking about the Fed being political. The Fed has been political, in my opinion, going back all the way to Arthur Burns, which was basically, that was Nixon days, right? Nixon put Arthur in, I believe. And that was the end of the Bill Martin, almost 20 years of, it was 20 years actually. I think it was just short. It was 1951 to 1970. So all of this stuff that we're seeing right now is politically motivated. And if there was no Fed, it would be politically motivated. And it's been, in my opinion, politically motivated. Look at, I went through the GFC with an awful lot of money under management at that time. And that was like it was actually easy strategy during 2008 is get out, just get out of the market. And we did. We got a lot of people out of the way and saved a lot of money. And in fact, it was a absolutely best strategy possible at the time. But the results of what we're seeing right now is still unknown. The classic word, air quotes, uncertain. Okay, so it's very uncertain right now on what's going on, but it is starting to see some cracks, which I'm going to try do my best to put together with looking at the Dow. I've been talking about the Dow going down to 90 or so. I think that may be just the beginning. Last night I went off on the whole gaslighting of the Fed about the 2% and full unemployment routine that especially they all do it. That's like the pitch they always put out there. Meanwhile, it's double that they've maintained over multi decades, going back to the 1970s. So this is all part of it, where they're debasing the dollar. Basically they're stealing our money day by day by day, and that's just the way it's going to be. So I think this is probably going in history that we'll go down and look at this whole scenario that we're seeing right now in that, how the best way to put it is going to be a transition from wherever we were doing to something completely different, and whether it's getting rebuilt because it got broken, or it ends up to be a design. Like I'm kind of stuck in a loop here, but the whole concept I don't think was thought out really clear before they came in. I was giving them a lot of kudos, and I'm watching. My job is to watch and see where cash flow is going to go, and right now it's going out the door. I think it's going to stabilize just a little bit, but we have a whole nother level that's very possible that we could test the lows this week. And I always love it when I see people comments on the YouTube channel. Please make comments. I love them. I try to read them all. I got through quite a few of them last night and respond to some of them. But somebody tell me there's going to be a double top, or in the next 3 weeks we're somehow going to go up 20% or 15%, and it's actually closer to 20. And that's not going to happen. I think we retest the lows. I think we're going to see a lot of things, but the key is going to be the Fed's not, I keep telling you folks, the Fed's not showing up for anything right now. If nothing else, you would hope that we would have a government and agencies and different players that would work together to make things work. But we have such a division, and you've got the deep state, and you got all these players out there, and they're being attacked, and so they're doing their best to attack back. And so we have the perfect scenario, in my opinion, to completely collapse the system in long ways. And it just kind of, I'm not predicting that it's going to collapse. I'm saying that the conditions are there. I always argue that, folks, if I have not called for any crashes for a long time. I haven't been into that mentality. I'm usually an optimist and see things going pretty well. But, I have to flash back to '08 and then maybe going all the way back to 2000 and the even '87 from the standpoint of how catastrophic things looked at the time. So I'm going to bring up this chart here in just a minute. Just bear with me while I get this up. So what I'm going to show you, this is that fact sheet that I ran, and I ran this on, this is a monthly chart. I think it's interesting that the primary trend is bearish, 8 out of 10. It's about as strong as trend as you could get. For this month, it's 85% bearish, so it's already down. But one of the things that, there's something else I'm going to flash over to. When you run one of these sheets, I'm so close, folks. I need like another 3 hours or so, and I should have things ready, because my plan is to get a version of this out and then have constant updates going. It'll almost be like your iOS on your phone getting updated. But this, the key insights: severe market crash. I'm just reading off of this box right here. Extreme technical divergence in PPM1 negative, but other PPMs positive, and that I will address as well. We'll bring up the chart here in a minute, and then so we're just going to transition, and I'm going to try to tie together my opening comments and going through the long-term S&P and all that stuff. Maybe we'll get to I may not even touch on the database. You can get that. And by the way, if you don't get the Substack, get the Substack. It's kendallreport.substack.com. There's a 7-day free trial. And also, I think it's $8 a month. And then you can get a full year for $6.50. It's $80 for a year. So get that, because that's where a lot of my microanalysis always is. And I have a lot of hours to think about it between right now. So for tonight, I think I'm going to trying to put together this puzzle of what's going on. But I thought this was an interesting run we're already below the STX level on the S&P. So this is the cash market, not the futures. And then volatility extreme, 3 divergences. The cycle position, I love this. I put a fair amount of thought in this, is capitulation, right? So everybody, it's, throw it in, throw in the towel here. But I thought that was interesting, and it does have highest probability trade, a long entry at 51.50, which I thought was interesting. Target 52.25, and then stop at 50.75, and there's that. Okay, so let me just stay on this thread here, and let's go over it. And let me put SPX up here. Let me switch over to this monthly chart. I'm going to tie all this together, just so stay with me. We got a little ways to go here. Before I switch off, this is what this daily chart here is showing a peak and then a momentum starting to go. The one thing that has happened, and if you have the indicators, you'll know that these things adjust. The all goes in the back, so it will adjust. It will look really extreme. So we see an adjustment coming here right now, which is as we get closer and get more data, we can see the future a little still blurry, but still clearer than it was. And what you'll see here is that the PPM2 is for the first time out about 5-7 days is starting to show that maybe we're going to increase. So there's a good chance, and I talked about this last night, this daily chart right now, that we'll see a right shoulder set up. And that may be what we started today. As bad as it felt and as negative as my comments were in the middle, this is the kind of environment that sets up at least a right shoulder and a rebound back into resistance levels. There's no big rally coming here for any reason. Like I said last night, there's no reason for the market to actually go up at all. And and I think with what's the new term out there, a panicking? I think Trump's become a panicking, and I think he's a little concerned if we don't get lower rates right away that things are going to implode, and he's not going to get lower rates, at least not from Powell. And I don't think he can just fire him like he says. Trump likes to talk big. We'll see what comes out of all this. But so let's go to this monthly graph, because this is pretty interesting in my opinion. And this, let me just bring up the graph to start with here. It's hard, they're blending together, but we went well below the extreme, and we went almost down to the 40-month, which will equal the 200-week moving average. So we've come just about to there. But what I want to show you is this, and I put this in a Substack last night, where we have this downward, we have this big wedge area. And I always talk about this. This is one of my favorite setups from the standpoint of being able to set up trades. Now, this is on we're out 30,000 feet right now on the monthly graph. But when you look at this pattern is set up. So I'm going to draw it in. From here, I think I'll probably go over, we'll probably go, what time have we got here? Not too bad, 18 minutes. So we'll probably go from this over to interest rates, and then we'll go to the dollar and hit gold. So I think tonight's broadcast is going to be along those lines. And maybe if we get through everything, there might be some time at the end. It's going to be a completely different structured video than I usually do. But let's just take a look at this, and I'm going to draw in this pattern. Matter of fact, that was the pattern from last night. So this thing has a memory. So let's go ahead, and this is where I'm talking about this declining 10 and this rising 40. Typically what will happen here is you're going to get a a market right here, this will be your trading zone. So just a simple moving average, monthly 10 on the downside will be the top, where we'll get the top end of the range. We're like right in the middle right now. And then the rising 40, it'll be the 40 and the 200 week are going to be the key support levels. They both have upward slopes in them. So the angle of attack shows that it's got enough upward angle that it's likely to support at these levels. That 10 month moving average that's on here is almost vertically down. And that's why the data sheet I was just showing you is calling it and talking about the extreme, basically calling it a crash, right? But this is the pattern here that I want you to look at. And these show up on 5-minute, 1-minute charts, anything you're trading. And what will happen is you'll trade in that range, and then you have to work your way toward the apex. And then at that point, you'll get a break up or down. And so from this case, we're looking at September, October to get to a point where we're going to be able to rally or sell off the next leg. So this thing that I'm talking about here, I need to make this clear. The thing that I'm talking about here is that there's going to be some consolidation. There's enough support, so we're not likely to get the collapse at the moment, I don't believe. The interesting thing about collapses and crashes, they just happen. The realities from my world and our money management and all that, we're already in cash for the most part. We're heavy cash. The last thing we'll do is throw out the last couple of things that we're still holding. But for now, I mean, we're positioned for the consolidation, or a crash if that happens. It doesn't matter from the money management side of my business. I don't care where it goes right now. There's not going to see a big reverse rally. There's going to be a lot of structure. I went through that detail. So if you didn't see it, go back and watch last night's video. I went through a lot of the elements that I'm referencing right now. It kind of ends up when I go through, now that I'm back online every day again, I'm just stair-stepping analysis. So sometimes going back to one video back, or maybe two, will bring in the context. I'm trying to tell a story, and then once again get the Substack, and that'll tie it all together. And if you want the analysis yourself, you can get the indicators, kendallreport.com/indicators24, and that will get you to there. But this upward range is really, let me bring the indicators back up. This is what is interesting about this. So now we bring in the momentum side of things, right? So now we go from looking at pure prices and just moving averages, all simple, and then we start looking at the algorithms, and they're all predicting more weakness, more downside. So even though they're doing this, that wedge is likely to hold in here. Okay, so if you just bring up an SPX symbol on your graph, all you got to do is put in monthly and then put in 10, 21, 40, and you'll get this formation. It's on my screen. Simple averages, not weighted. But the results are saying that we're looking at into November. Now, I've been talking for a while here about this scenario of we're looking at Q3, Q4 before this thing is going to play out. And at that point in time, we're probably going to have some negative numbers coming out of the economy. And once those numbers, that will be a confirmation, probably right while the market's trying to set up a low in Q4. It's a typical lagging kind of deal. The people always say the stock market leads the economy by 6 months, and you'll hear terms like the market is not the economy, all that kind of stuff. But this is probably what's happening here. So those little cliches probably play in pretty good at this point in time. But the results of this probably is still going to be holding that 200-week, 40-week moving average. If we break through that, then really, there's nothing under this market. Maybe you could point to, back to November of 24, turn the clock back a year. By the way, I just happened to look at a chart. I thought it was interesting. If we go 1 year from the close of today, looking back on an annual chart, we're still up 3.3% as of today from where we were last year at the same time. So, this is feeling pretty dramatic, and it is, but I think this is the consolidation, and then possibly we could end up going down to, I'll say it out loud. I hate to say it but we could end up going down to the 200, and that's a big 200 month moving average. That would be huge. I mean, that's 2,700. So that would be a more than a 50% decline. I'm not predicting that right now. This is still in place. The algos are suggesting after this consolidation that we look out, it's going to go sideways. That will change, and as we get down the road. And this is a monthly graph, so this is like watching paint dry. So we won't know a lot. We'll have better insight once we see what happens if these numbers that we printed 2 weeks ago are the low that we printed. That there's a lot of things out there that need to be reckoned with yet. So I am going to go over, and I'm going to bring up the. I hope you caught this. I almost put the commentary last night for the WaveTech database in, up at the top so everybody would read it. I hope you folks read that if you get the Substack letter, because I'm going to reference it. I'm going to bring this back, and I just want to. I'm going to update this so we can just see what happened today. So I'm going to go to the database. So we did S&P, kind of longer view. So we're down. Let's see. We're at 16, 17. So slightly. Let's see what the rotation was. Interesting. We actually, even though the markets were down hard today, I got to check. I have to check something. I didn't check it before. Okay. Yeah, it's good. So even though we were down pretty hard today, we got a positive rotation database, which is somewhat interesting. Take a look at this, 16, 17. You got basically 300 exits, and you got 600, 700 new buys coming in. So that's an interesting rotation, and no new sectors coming in. But so that's an interesting rotation. You would have thought we would have got creamed on today. And one of the things that I talked about, so if you don't have the Substack, sign up for a free trial. You'll be able to see the back issues. But I just want to touch on this because one of the things that we have heard forever is that, the Mag 7 is the only 7 stocks that are moving in the markets, which couldn't be further from the truth. Those of you who've been around the channel, what my argument was in the newsletter last night was that you need structure, you need a lot of support behind the market. So when we were seeing these big rallies in 23 and 24, we were seeing around 61%. The database on intermediate stayed above 61%, went as high as 78. So literally 6 to 7 out of 10 stocks were actually trending upwards. Not 7 stocks, but possibly, what is that? That's going to be, 11, 12,000 symbols that are in this database were all trending up. So, and now we have the inverse where if we look at if I go over to the weekly real quick here, the weekly's at 18%. So we only have 2 out of 10 stocks trending up, and the markets are going down, right? So it's an inverse of what we saw in 23, 24. Now in 25, we're seeing where there's very few stocks participating in the rally. And my argument is that without that structure, without that basis underneath, there's no way, like when somebody says, oh, the market's going to rally up and make a new high or retest the highs, There's no basis for that because there's not enough stocks participating. You need that that background in the breadth of the market needs to be there. It's not just 7 stocks. It's never 7 stocks. Now, in the weighting of the index, they influence the biggest part of the returns, yes, but you still need that structural part of the markets, which I talk about all the time. You need to have a lot of stocks, not stocks above the 200-day moving average. Stocks that are trending. In this database, we're looking at stocks that have high probabilities of them appreciating over a period of time. In the intermediate, it's like 200 days. Right now, like I said, there's 2 out of 10. All right. So from here, I'm putting a story together, and I'll try to summarize this when I get done. We'll see if I successfully pull this off. But what we're going to do is we're going to look at interest rates, and then from there we'll go from interest rates, we're going to the U.S. dollar, and then we'll go gold, and then we'll cover Bitcoin. Bitcoin had a pretty big day today, so let's try to do that. So let's go ahead and take a look here. I think it will make the most sense if we go to we'll use the 10-year. I'll bring up the yield curve. Somebody was asking me to do that, so we'll probably get this done. We're seeing this is we'll just stay here since it came up, but this is the monthly. Wow, yeah, we got to break this down. There's a whole lot of stuff going on here. So if you're new to the channel, welcome. But I want to point out these dots are here, Fibonacci targets, and we have one of our indicators has a pattern recognition tool, so it recognizes patterns and it will extrapolate out Fibonacci targets. It'll do it on a 1-minute chart. This happens to be a monthly, but there's a thing that happens with the indicators, and I want to draw this in, and because this will tell us a lot about the structure of the 10-year and what the potential is going. It's kind of scary what I'm looking at here, but let's go here. Let me bring up the drawing tool, and so. All right. This pattern right here, there's a couple patterns, and it's going to look. This is going to look a lot. I'm just going to draw it in, and then I'll talk about it. This is classic Elliott wave stuff. Okay, so this is the 1-2 off the bottom. We'll get the leg 3, and then there's a really important rule if any of you are doing Elliott wave. There's a section coming up in my book about this, but the real basics is what is important without getting into the intricate parts of the wave theory. But we get this 1-2, and there's a rule of alternation that is talked about, and that rule of alternation says that if the first correction, wave 2, so there's 5 waves in a pattern, waves 2 and 4 are the corrective. If the first wave is simple, then the next one will be complex, meaning there'll be a pattern, there'll be a wedge, an ABC, XABC, double threes, all kinds of patterns that are possible. And this one here is probably an ABCDE pattern. And this is going to be, you have to coin this whole section here. Let me just get rid of that. Let's do this right. So this whole section right here is going to be wave 4. This is the wave 2 from the standpoint of the first correction, second correction. What does that tell us? If this is going to be a big 5, then the next level out here is going to be heading up this way. And we have some Fibonacci targets. So I can get to the first ones. I'll have to take this drawing tool off to get to the actual data. But for right now, the three targets to the upside, 535, 601, 642, 6.42%. We're talking the 10-year. So if this is the case, and I brought this up, that there's the magic number here is 4.72% on the 10. If we take that out, then these fib targets are probably going to get hit. That will suggest that we're starting the sequence up on that level. Now, this is a very long-term monthly chart. So this is the big stuff. This is the major secular trends that are out there. And if we could go a bit more sideways, it's interesting. I'm going to clean this up so you can see this. Our little algos are 1 day or 1 period close algo. Algos are saying that we're going sideways here. We're not going to do this, but that magic number is going to be, on the breakout, and then this is it. So let me address these lines up here. So this was the original objective, which was ridiculous numbers, up to 9%. I'll give the numbers here in a second. But these have been invalidated. And let me just draw in where this came from. So this was most likely when was a pattern that was picked. It's got to be picked up right here, and then these were the projections that came out of the fib projection tool, and you'll see low targets right in this box over here on the far side of the screen. This is the WaveTech Fibonacci, and it's set on power of 6. If you got the indicators, you know what that means. But that was the huge, that's catastrophic. That's the bond market. No one believes in the U.S. markets anymore. This is the real capitulation. I'm a bond guy from way back. I'm not an equity guy. Okay, so I was a bond trader for the better part of 20 years. And I was a bond trader when bonds were in the dirt, so to speak, because we're trading bonds when, the 30-year was at 17%. And I laugh at people who go, oh, no, it's at 4%. It's pretty funny. When I started the market, we went to, there was I think the last 30-year issue that came out was a 16 3/4 coupon, 30 years with a 20-year call. And I remember this offering like it was yesterday, and it traded a discount. I think it traded down to $92. You could have bought that thing for $92, and it went to 170 in price as yields declined over the next number of years. It was the trade of a lifetime, just talking about buying bonds and making a big deal. This is a very dangerous range, because if you look at the average over the last 45, 50 years, you're looking at about 6%. So we're still below what's normal on around the 10-year, around that mid-range stuff. So, all right, I don't want to get too far down the trail here. But these projections oftentimes never get met. But then you get the reforecast once the pattern is done. So now we're going to see if we can hit these levels. So let me clean this up so we can talk about what those levels are. I have to take this off the screen. And so, yeah, so those levels there, 719, 869, 962. That's these big patterns. So those have been invalidated. Now we have the new pattern that I was talking about I'm just looking here. Those are 535, 601, 642. So 545 just hardly gets us above there. So I know I kind of did a mini Elliott wave class tonight, but if typically what you're going to get is that wave 5 and wave 1 will be, there's a term, I love this term, somewhat equal. Means they'll be close to the similar values. So if we just project out, hang on, if we just project out, that puts us roughly at this 640 level would be 1 in 5 equal. That's just a guesstimate. I didn't do the actual math, but it's close to that, right? That would be disastrous, to say the least. Okay, so let's do this. I've used this site before. They've kind of junked it up because they want to get paid. Um, there's a site called U.S. Treasury Curve. .com, and I get a lot of ads that come up and stuff. As soon as they'll start popping up, they ruined this. I realize I want to get paid, but you know, there had to be. I guess nobody signed on for their Patreon, so including me. I've been doing that, so I guess I. So let's go back and do something here, if it'll work. So what I'm going to do is set this back. We're going to set this back to what it looked like in January of 24. So this is interesting because if we go just back to here, look at the red line is the I'm just looking here. Yeah, so that's going to be the old yield curve. If we go, hang on. Now it'll work. It wasn't working. So this is what we looked like in January of 24. We went down, and now we see the restructuring. So what the Fed's done, they brought the front end down, been around the channel. I told you this was the plan all along, and ultimately was to flat line right around 4%. So we're at 4.25 on the Fed funds. We're out here on the 30 right now. You know, we're luckily, let's see, 428, 435, out that range on the back end of the curve. I still think they want this front end of the curve to come down. So I do expect the Fed to lower rates, but it may not be until September. I saw a story out there that they might raise rates. I don't think that's even close to a possibility. But what I've been projecting for a while is that the yield curve would be what's called a steepener, and you would have the Fed funds at 3.2 and the back end of the curve at around 4%. Now, what I just talked about on the treasuries, if that happens, then there's a whole nother ball game here, okay? Because now all of a sudden we're looking at a, let's say 5.25 to 6.40 yield on the back end, and that they may do nothing if that happens. They won't move that front end up at all. They'll just let it become a steepener. And at that point in time, believe it or not, if that happens, it's probably going to be finally the time to buy the Russell. Not right now, but at that point in time. And we don't know if that's ever going to happen. So do we get in the 5.25, 440 range on the from that standpoint on the yields? We'll see. Okay, going to the US dollar now, okay? This is probably good. We'll take a look at the dollar index. I want to make, so we have big red bar down. This is a monthly chart. What I've been talking about is coming down. This is 91 bucks down here at the 200 month. And you see, this is most likely a distribution pattern that is set up here. And we're starting to see, you notice that these dots, I developed something called WTARs. They're WaveTech. These are auto regressions. This is projecting, or we'll say predicting, what the moving averages are going to look like. And this is a monthly chart. So this is all the way out in 28. But we're seeing that the moving averages, everything looks like it's going to roll over. If I bring back the indicators, you're going to see really just kind of a maintenance level kind of projections where the indicators just get into a range where they're saying they're on that downward slope. That's why they look like they do. The WTARs are using these PPMs to project what they're going to look like going on the back end as the projections come out. So the realities is that it looks like the Dow is going to be trending down, and it looks like Dow are trending down 27, 28, and maybe beyond. Going to, and I said early on this broadcast that I would talk a little bit about the reverse fundamentals, and so let's just go there for a minute, okay? So I'm going to summarize what we've done so far in this video. Hopefully I did a good enough job that I walked things forward. You can go back and watch and get the context of what I'm saying here. But basically, equities are consolidation and another leg down. We look at the interest rates. You just saw the configuration there where there's a potential for bonds to get collapsed. So anybody doing if you have an advisor doing 60-40, fire him, go to cash, because that 60-40 portfolio is going to get destroyed. Okay, it's already a bad idea. It has been a bad idea for 10 years or more. But you got bond prices going down, equity prices going down. It's a disaster happening. And that's just going to just ruin capital. 401ks, most of these 401ks and people go. I've had have a client, institutional client of mine, that we had a pretty deep conversation about this. And so there's a major, I always forget the name of the big government pension plan or 401k. It's got, I mean, it's huge. There's tens and tens of millions of people in this thing. Almost all of them are in the money market fund, which is actually the best place to be right now. And those that are trying to do 60-40s and those kind of things are getting in trouble as the days go by. And there's just a lot of destruction of capital going on. And I would even say, you haven't seen anything yet, because this has got to play out. If we just look in the rearview mirror for a couple minutes and we ask, what have we seen behind us, right? We've seen massive, going back to the sick days, right? I don't even want to say the word here because our friends on YouTube don't like to hear the word. But if we go back to 2020 and we look at what happened, massive money input by the Fed, the shutting down of the economy, and then the reviving of everything. And then from, we'll just say 21 on, the pumping of cash, the pumping of people into the country to inflate everything. Now where we find ourselves, and this is the reality, is we have to basically normalize all of these events, and we have to get capital out of the market. So how do you get capital out of the market? Nothing like a bond market going down, nothing like equities going down. So we need to collapse a lot of this capital. And what people don't realize is like if you're a futures player, you got guy on each side making money on equity and on bonds, and money gets vaporized. I mean, it's gone forever. Okay, it's not coming back. Where on the future side, there's offsetting. One guy's got to pay the other guy, right? But in the equities, when these things collapse, like you saw Nvidia go down today, all of those type of things, that money's just gone. Okay, it's vapor. It turns into vapors. So the point of this, we've got equities going down, potentially see bonds going up into a 5% range, and then we get the U.S. dollar. It looks like it's going to go down. If you go back to yesterday's video, there's a theme going here. Somebody made a comment, Bob's all over these days. There's so much going on, it's hard to grasp onto any particular theme. In the past, on most market environments, there's only one thing going on. Well, there's 4, maybe 5 things going on at the moment. But then we get into the U.S. dollar, the debasing of the dollar that I talked about last night, the gaslighting by the Fed and virtually every government agency as they quietly stealing our money through this 2%. 2% inflation is supposed to be good. It's not good. I showed you that last night. Watch that video. And then we get to the U.S. dollar. So this is where the reality is. I'm going to put a chart up and we're going to go. Let's see. Man, this is good. This is going to be good timing, I think. So I'm going to leave this monthly chart up here, and I'll bring it up on screen for you. It's gold. Gold's telling you what's going on here. This is the story I just told you, and this is the reflection of everything I just told you. And the result of this is that we've got to reconcile all these things, and it's not going to be pretty. And I think back to the whole theme of tonight's video is Trump panicking? I think so. I had some. Let me just look at my notes here real quick. Bear with me a second. Yeah, I've got a electronic notepad, so it's got to power up. But yeah, just a second. It's popping around. I don't know what it's doing. Great, it's out of battery, so I won't be looking at that. But the point of all this is, I think the tariffs are, this extreme little exchange that's gotten into China. And sometimes when you get into fights, nobody wins. And like I've been saying that we're in an economic war with China, and we are. And I think everybody's going to get hurt on this thing. And I think that's why Trump is screaming as loud as he can, lower rates now or the economy's going to collapse. And we'll see, like I said, just to kind of summarize, I don't see that Powell's going to do anything. What a terrible situation. You've got a president of the United States and a Federal Reserve chair that don't like each other and are willing to spite each other. It's not good. So listen, I don't know where this is going. I'll just go back to some of my earlier comments that I think this is potentially a really bad situation, but this chart right here tells you what's going on. Okay, everything I just told you led you right to this, and I thought it was silly adding positions back in like 2,400. Well, that was almost $1,000 ago. But if you look at the projection here, so let's go on this for a minute. As if we look at the projections, the dotted lines are the forecast of what's likely to happen with the moving average. The red dots are the forecast on a one period close. Well, this is a monthly chart. So this is showing you that, ultimately, let me just bring up some numbers here. Yeah, we're looking at 4,300 on gold. And by the way, that's 2028 out there. Does it happen sooner? Who knows? We're already in a vertical rise. So when you get into these type of markets, like we're looking at gold, let me bring up the indicators for a minute. I talked about this the other night, is that we are hitting peak values, but that doesn't mean this is peak values in momentum, but momentum will bleed off over time, and there's a lag effect. So we're looking at, this is interesting, all the way where momentum really starts to bleed off. We're looking at first quarter Q2 of 2026, okay? So this is, well, you're seeing peak values. If you understand the angle of attack, and I'll probably should bring that in one night. I used to bring it in occasionally, but if you look at the angle of attack here, these trends are not going to dissipate anytime soon. So, and if you get some of these events, if they get exaggerated or they all happen at once and they're all related, everything I presented to you tonight is related. So I think where are we at here? 5 minutes. Yeah, we're just going to end here. If you want my Bitcoin analysis, get the Substack, kendallreport.com or kendallreport.substack.com. So everything I put together tonight, actually it flowed better than I thought, and I'm glad it did. But I think if you go through everything, all of this stuff is related and they're all interconnected right now. And that is, it's kind of scary. I can tell you from a guy that has been around, like I started in 1979. I got to go through interest rates and the bonds collapsing to an 8% coupon bond went to, I think it was, 56 on the handle. So it was, I used to joke back in 1980, 81, the government's having its great two for one sale on bonds. Buy one, get one free. And that's how crazy it was off of those 8% coupons. So I've been there, been through 87 crash in the .com and the GFC, all that stuff. And we're still here, okay? I don't know where this thing goes, but it's all of a sudden turning a little bit south. So maybe the negativity will get to the level where a bottom will come in. But I hope I made this clear for you tonight. Wish I could have looked like there's some great comments that were going on. I wish I could have participated. I didn't want to lose my focus trying to interact with you folks, but I appreciate it. I'll try to get through some of them. Make sure you hit the like button if you enjoyed this content tonight. Subscribe. I come on every day again. I think this is going to be, I'm going to be able to maintain this for the most part. And we'll see how this thing plays out here. But just know that there are some serious challenges coming on, and don't get too excited about picking bottoms. Those of you that were around back in early 2020 when all that was going on, we actually picked the market pretty solid there in April and May of 2020 on the turnaround. And there was even some stuff that started happening a little bit late March, early April, and we caught that thing on the turn. And that was a much different situation. That was an opportunity of a lifetime, I think, from the standpoint. If you were able, it so happened that once again, our models were mostly in cash in January of 2020. And our portfolio managers and people we deal with are like, why are the models telling us to get out? And my answer was, I don't know, just do it. And we were at all-time highs on the markets when all this happened, by the way. We were very close to within a few percent of the all-time highs when 2020 happened. So it was like perfect timing. We got out, then it collapsed, and then that quick turnaround was different. Fed pumping money, everything trying to plug all the holes that were created. And that doesn't exist here. We're in a much different situation. I always say that you can't trade looking in the rearview mirror because every one of these situations are very different. So you can't compare 1929 to the GFC to the whatever. It just doesn't work. There might be some similarities, and people will point that out. One of the things that has been thrown around a lot is that in 1929, especially early 30s, that they tried to do tariffs then, and it was very bad timing. little bit different timing right now, but I'm thinking I'm hearing panic going on with the president. I'm looking at some folks getting a little concerned, and rightfully so. We'll see if Bessent and all these guys, Bessent and Howard and the boys, see what kind of confidence they put out there. But this, I think, is about to get challenging. Doesn't mean we're going to collapse tomorrow, but please go back and watch this video. I feel like it flowed really well tonight. These live streams are always fun to do, but I kind of set up this whole scenario, and I feel good about it. If you did, hit the like button, and we'll go from there. So this is going to be it. I appreciate everybody watching. I got your favorite song coming up here in a minute, so make some comments as we trail off here. Have a great evening. See you tomorrow. Hey folks, I've been looking through the comments. Thank you so much for this. There's some great comments here. I'm glad I didn't look at this. I would not have been able to focus. There's some really good comments. I appreciate everybody.